Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Jeff Barton, The Mortgage Voice. Welcome back to the show. Really appreciate you listening each and every week. Hey, check out our website, mortgagevoice.com. There you can find the latest on-demand episodes of The Mortgage Voice, information about our guests, as well as their contact information. You can also read my blog. Hey, how about that? Which keeps you updated with the very latest mortgage news. Check it out. Bookmark us. That's themortgagevoice.com. Again, I'm Jeff Barton. This is The Mortgage Voice. We take each and every week and we talk about what's going on in the world, what's going on in the economy, simply as it relates to your decisions about buying and selling real estate. Basically, your home, you're going to go out there and buy it, or you're going to sell it, or you're going to refinance it. You need information that's going to tell you what's happening to the rates. And really, most people, that's all they really care about. I was talking, well, I belong to this club, right? And we go out for walks and hikes and jogs and things like this about 3 times a week. So we're out. And someone asked me about the mortgage rates, and I said, you know, mortgage rates themselves are dependent on a lot of different things. We've had massive amounts of government help, which has kept the mortgage rates down, as everybody knows who's listened to this show, why and how that's occurred. Global events as well keep mortgage rates volatile, right? And I was talking about how if, in fact, the Russians invade the Ukrainians, how that world crisis will send people buying U.S. treasuries, the bonds, specifically the 10-year, and how that particular event will drive prices down, will drive rates down. And so I said, a lot of people, because, you know, let's face it, if it's going to benefit me, I probably want it to happen. So as a joke, I was saying, yeah, so people are probably rooting for the war to happen so the rates go down and they can afford a house again. So everybody gave a little chuckle until the guy in the back said, you know, I'm from Ukraine. I was like, oh, man, you got to be kidding me. So turns out that his grandmother and went through World War II, and this long, very awful story about the decimation of his own family. So obviously I'm not rooting for that. But as a result of something as horrible as it is to that guy, his family, and many other families, it would benefit people in the mortgage rate, for the mortgage rate here in the U.S. It just, why things are the way they are and how they are affected. It's not a fair world, but it is a world that you take advantage of, I guess is what I'm trying to say. So how do we educate people to take advantage of what the situation is now? So what is the situation? 3.87 is the 30-year fixed rate today. It's on average 3.87. We're going to hit 4% sooner than later. We were predicting late next year, not next year, late next year, because I thought it was 21. It's 2022, so I'm thinking, okay, the end of the year we'll be at 4%. Well, it's quite possible we're going to be at 4% before the end of the quarter. And so as rates rise, as you've seen them rise at least a point in the last year, if not a point and a half, depending on the type of loan, what and how are you going to take advantage of a situation at 4%? Well, first off, 4% is smoking rate. If you'd said way back when I had a mortgage at 5.25%, that rates were going to go to 4%, I would have been ecstatic, like unbelievable, never heard of, lowest they've ever been. Since we've been in those days, and I'm not recommending anybody get out of a 2.75% 30-year fixed rate. Why would you? But if you are heading into a 4%, currently today at 3.87, we're very close. 4% is still a pretty good rate. 15 years at 3.13, that's a great rate. I even think you can get below 3% if you shop around a little bit on a 15-year. The FHA is at 3.50, 3.43 for the jumbo, 3.67 for the 5/1 ARM. All of this is based on going back to the normal way that we're looking at loans, looking at loan rates, i.e. the 10-year Treasury. Now, there are caveats, right? And that's a word I never knew what it meant. It just means there's other things that you have to think about when you're looking at a base rate of whatever it is that I just quoted, whatever it is I just said. The caveats are plentiful. And every day or every week, somebody comes up with, oh, this happened in 19 blah, blah, blah. And I was like, what? I never heard of that. Some reason why the rates went the way they went. And given that particular scenario in today's market, this is what it's going to mean for that particular rate. You want to follow rates? Plenty of places to do it. Don't sign in. Don't pay for a subscription. The only reason those sites exist is because it leads to you getting phone calls and emails because somebody has purchased you as a lead. So just surf around, but don't, plug in, ask questions, join, email a query. Don't do any of that because, as I said, the way the internet works, and everybody knows it by now, is if you look for something, you're going to get bombarded with that something from now till the end of time because that's just how it works. I'm a sports fan, big sports fan. Super Bowl coming up this weekend. So I follow my teams. Sure I have. I have since I was a kid. So every day I wake up, turn on whatever site it is, and it doesn't really matter what site. I get bombarded with those particular teams that I've been looking at. Not that they're any less or more important than the news I would currently look at if I never looked at, search for anything. But that is the way it is. Now, these rates, still good. Problem with the rates, okay, housing. There is none. There's less housing today than ever on the market. I think I quoted last week some abysmal number out there. Now, this is the time of year where things aren't on the market anyway. If you were selling your house last year and you wanted a certain price and you didn't get it, chances are your realtor would say, hey, you should take this off the market so that when we bring it back on the market, it will look fresh. Because all the realtors who look at properties on MLS websites, they look at days on market. Because if days on market are more than, 2 or 3 weeks, they're thinking, aha, something's wrong with this property. I'm going to lowball on an offer. So if your realtor said, hey, it's December, nothing's moving right now, and you're not getting your price, take it off the market. We'll put it back on the market in March. That's why there's not a lot of property on the market. And those foreclosures that were supposed to happen, the word that we used to use back in '08, the shadow inventory of all these foreclosed homes, where are they? They're not coming either. One of the things about housing in the U.S. is that the 2008 mortgage, Great Recession, taught us that big corporations can come in and buy a lot of properties really cheap, hold on to them and rent them out, and use that as a basis by which they can sell their own bonds or stock price or whatever else they're selling, not to mention make a ton of dough on the rent. So that's what's been happening, and that's what's going to happen this time around, if and ever the banks decide to sell these particular properties. So what's the way out? What is the way out of these particular problems? Well, rising interest rates, which is what the Fed is going to do in March, will help. Why? Because it'll make housing less affordable. So if you're out there looking for a first-time home, come March, your house is going to be more expensive. Why? Because the lack of product and the cost in their mortgage is going to go up. These are not great things, but they're what's happening. Unless, of course, as I mentioned at the beginning, there's some catastrophe or some weather emergency or something that happens that says, hey, COVID is over. Yeah, COVID is driving all economies around the world still, and probably will through the end of the year. Now, we in the U.S., as well as many, many, many other countries around the world, are looking to ease restrictions on mask wearing and going out into the world to resume some sort of consumerism. We'll wait and see, because I'm not quite sure whether that's the answer. I don't know, but if we do that and then have to lock down again, not good. People get weary of that, and it just makes people cranky. So is it better to leave everything in place or to open it up for good? I kind of lean on the latter, but anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Really appreciate you tuning in today, as you do each and every week. And we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Thanks very much for listening to the show. You know, the show is available whenever you need information, even if you need it right away. To fit your busy schedule. Hey, we're all busy. If you need information, you want it right now. We make it easy to watch or listen to the show. Find our episodes on demand from our website. Hey, go to the website, themortgagevoice.com. We're also on SoundCloud at The Mortgage Voice. And our Mortgage Minute weekly programs always available at YouTube. Jeff Barton, The Mortgage Voice. That's how you see us on YouTube. Podcast form, wherever you get your podcasts, including Apple, Google, Stitcher, Spreaker, Podclips, Spotify, and more. Check us out. I'm Jeff Barton. This is The Mortgage Voice. Thanks very much for tuning in. Again, that's a quick hit on exactly where you can find us and how you can, relate to the information that we're trying to bring to you. We're educating, really. That's what we do. We bring information to you to make better decisions about where you're going to buy. I don't care where you go to get your loan. I don't care where you go to get your real estate. But to find information about what is the best thing for you to do, you really can't go very many places. I've checked it out. There's a few people on YouTube, but one of the guys that I'm going to rely upon today from Deep Haven, it's a first time for Justin to come on. Justin Hardman, he joins us now to talk a little bit about what's going on there at Deep Haven. Justin, how are you?
Hey, doing excellent, Jeff. How are you?
I'm great. Thanks very much. Okay. Most people don't know Deep Haven. It's not a household name here in Southern California or the other 4 or 5 markets that we're in. We're in Albuquerque. We're out in Vegas. We're in Northern California as well as the Inland Empire. Tell us, what is Deep Haven? What's the niche? What do you guys go after in terms of product for the buyer?
Yeah, absolutely. And I'll just say the goal is to make Deep Haven a household name in those areas.
Good.
We are a national lender, and all we do is non-QM, non-agency.
Okay.
So that obviously that opens up to a bunch of different possibilities. Our real focus is on your bank statement loans for self-employed borrowers. They've been left out in the cold since 2008. And even since 2 years ago when the pandemic hit and took down a lot of small businesses. So obviously, as you know, there is a great need for non-QM, not just for your self-employed borrowers, but maybe it's for some of your lower FICO borrowers, your experienced investors, non-conforming loan sizes, and sometimes even borrowers that have recent credit events.
Listen, a lot of people hear the word non-QM and get confused. Now, the term has been around for a long time. It's getting more and more popular as rates rise, where people are priced out of a certain product with a conventional lender. They look towards other sources. What's the difference between, let's say, a conventional 30-year and a non-QM product like your bank statement?
So, as far as the product is concerned, it's all about how we underwrite the file.
Okay.
So, your Fannie Freddie lenders, obviously, you have the AUS automatic underwriting systems. Pretty cookie cutter. We are very hands-on. The manual underwrite, it's common sense underwriting, so we're actually going to look at the borrowers. Say, for instance, if we're doing a bank statement loan, we're going to look at the borrower's most recent 12 months business or personal bank statements and determine the borrower's actual true income versus their income after tax write-offs. Okay. As far as pricing is concerned, it's very situational. So, I have low rates all the way down to 3.99, 3.875 right now. And some rates are, in the 6s and 7s. It's very situational.
Right. And in terms of these products, you talked about manual underwriting, which is kind of the way that used to be done before the push to automation, and especially with the big companies like Rocket and UWM, really pushing automation to lower costs. In a situation whereby you have to look at a borrower individually, does this slow the system down? For instance, I got a 30-day escrow. I got to get these loan docs out. If I come to you and say, hey, I need this loan done ASAP because, these borrowers have to get in per contract, what's the speed? What's the turnaround time over at your place?
Yeah, so it's actually absolutely not a problem.
Great.
We average 30 days or under. I actually just recently closed a loan. Granted, the appraisal was already done on it, but I actually just recently closed a loan in 15 total calendar days.
Wow.
So while it is hands-on, we have a very experienced and professional, again, common sense, but experienced and professional underwriting staff and operations staff. It runs extremely smooth, so there's almost no difference between a non-QM loan, with Deep Haven at least, and your conventional cookie-cutter Fannie Freddie loan.
No, that's excellent news, because of other things that go on in a loan, the time on a purchase is always critical, and I can't tell you the number of times you're getting panic calls from either the borrower's agent or the seller's agent, wanting to have updates on an hourly basis. Without having to do that, a company like Deep Haven solving the problem of time really does help, believe me.
Absolutely, absolutely. And that's something I personally, in Deep Haven as a whole, we pride ourselves on, is the communication with our broker partners, the communication with our borrowers. If we anticipate something is going to cost, say, for instance, an appraisal or, tax transcripts, if we anticipate that is going to take longer than possible, we inform the broker and we inform the borrower.
Appraisals, tell me about it. Are they slow? Have they picked up in terms of the availability of appraisers to get out and do the appraisals as quickly as possible? You mentioned the one that already had the appraisal done. What's your typical turn time? We've had some issues with that in some other lenders.
You and everybody else.
Yep.
We actually, so we relaunched Deep Haven back in October of, what is now, 2020, right?
Yep.
So about 6 months after the whole country shut down. We did a complete revamp of a lot of different processes, and one of those was our AMCs that we're using.
Okay.
We got rid of a few different AMCs that were causing us issues, whether it be valuation issues or turn time issues, and we heavily vetted 3 new AMCs that we're currently using right now.
Great.
Since we've done that, turn times have absolutely improved. Are
Great.
they perfect? No. No appraisal will ever be perfect, or no AMC will ever be perfect. But the turn times, the valuation reports, they have done a complete 180.
That's good. Now, you mentioned appraisals themselves. Property values accruing the way they have been. I mean, last month was 1% over the month before raise in prices. How is the appraisal keeping up with the current market value, especially if the comps aren't keeping up? Are you finding that purchase contracts are, falling less than what the offer is, and that sometimes can complicate the loan as well?
Yeah, I mean that certainly does happen from time to time. I tend to advise my brokers, this is the way I've always personally operated as a loan officer, is to be conservative.
Right.
Because you do want to be safe. Very rarely do I have a big issue with any sort of appraisal valuation coming in lower than the purchase contract. Obviously, refis sometimes are a little bit a different story.
Right.
But as far as the valuation on purchases, 9.8 times out of 10, it comes in at or above the purchase price.
Oh, that's good. No, we have now, because of the fact that us at Malibu Funding, that's the company that I work for, they did a number of loans where the appraisals, especially in a state like Arizona, where you have a lot of rural properties, it was just difficult to find comps. So even though properties would sell higher price, they just couldn't find a comp to justify the loan. So borrowers were having to come in with extra cash to make up the difference. Nobody likes doing that, and so it just leaves a bad taste for everybody. Nice to hear that you really haven't had that problem.
Yeah, not really. Obviously every loan is different, every property is different. So,
Sure.
There are occasionally issues, like you were talking about with comp issues, right?
Right.
Typically we vet the property pretty heavily before we actually submit the loan and order the appraisal. So rarely do we actually have that issue where we have issues with comps.
Right. Okay. Hey, listen, we're up against the clock. I want to give people a chance to get in touch with you. We try to give them not only the opportunity on the website, themortgagevoice.com, to see you, but also to contact you directly. You want to tell them how they can do that?
Yeah, absolutely. So again, my name is Justin Hardman, and my direct phone number is 704-661-2699. You can call me, text me directly on that anytime, or you can shoot me an email. It's just JHARD as in David, MAN. So Hardman at deephavenmortgage.com.
Justin, thanks very much. Appreciate it. Love to have you back. Just the update as the year goes on, and it's going to be an interesting year as rates rise. But I appreciate your time.
Absolutely. Thank you very much, Jeff.
Thank you, too. That's Justin Hardman from Deep Haven Mortgage. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
Listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I am Jeff Barton, and this is The Mortgage Voice. Welcome to The Mortgage Voice. Our show is available whenever you need information, even if you need it right away. Fit your busy schedule. Hey, make it easy to watch or listen to the show. Find our episodes on demand from our website, themortgagevoice.com. We're also on SoundCloud at The Mortgage Voice, and our Mortgage Minute, which is on all our social media and weekly programs, is always available at YouTube. Go to YouTube, Jeff Barton, The Mortgage Voice. In the podcast form, wherever you go to podcast, including Apple, Google, Stitcher, Spreaker, Podclips.io, Spotify, and more. Our show is everywhere. We are a fungus. You can't get rid of us. Excellent. Anyway, I'm Jeff Barton. Thanks for coming to the show, listening to us talk about rates, talk about programs, talk about all things mortgages. One of the favorites to come on the show is Nina Penny, who talks a lot about reverse mortgages. She's the expert in the field, both with us, of course, but nationally. And welcome her back today. Nina, how are you?
I'm doing great, Jeff. Thanks for having me on.
Thank you very much for coming on. First off, how's your year going so far? What is happening in the reverse world? What do you foresee in the immediate quarter?
Well, for the reverse mortgages, we're still seeing a lot of refinances coming through. And we're anticipating that to continue as long as rates stay low and home values go up. If you've refied or if you've had a reverse mortgage for more than a year and been the benefit of a great home increase in value, you may want to look at a refinance of your reverse.
Okay.
Besides that, purchase business is really popular.
Yeah, let me ask you a question on that because it's fascinating. I think a lot of people get confused about reverse mortgages, thinking it's somehow a very complex thing and it doesn't work like a regular mortgage, when in fact it does. So refining out of one reverse into another reverse is not as difficult as possible, especially taking advantage of rising home equity. I believe that's what you're saying?
Correct.
Okay, tell us how it specifically works. Give us some nuts and bolts. Somebody's got a reverse mortgage. They've had it for 10 years. They need some money to take out of their property because it's risen in value. What would they do?
So basically what you're going to do is if you've had their loan or if you've done counseling within the last 5 years, you don't need to do it again. So that's great.
That's great, yeah.
That saves you a little cost there and some time. Mm-hmm. And then what we'll do is we take a look at the estimated value of the home and the current payoff and the fees and make sure that you would qualify. And if so, then it's just a process over again. You know, we're still going to qualify you on residual income. There's still going to be an appraisal. But what we're going to do is probably if you've had the loan for more than a year, you're going to lower your interest rate.
Right.
Maybe get some more cash out. And, restart the loan all over again and probably have a lower MI policy than you did the first time.
Okay, tell us a little bit about how the rate works with the reverse. Is it it's an FHA loan, so you're looking at FHA rates, or does the reverse have a special rate unto itself?
Well, right now, traditional FHA forward loan is probably 3.5%.
Yep, it is.
And the reverse mortgages right now on the adjustable rate, we're looking at approximately about 3.38.
Okay.
And that's an adjustable rate, but that's kind of the start-off margin of it.
Okay.
And so that has a lot to do with how much money you'd have access to.
Right, and the money you will have access to is 50% of the value that you have in the property. Like if you have $1 million home and you've only taken out $300,000, you probably have access to another $200,000, something like that.
Well, reverse mortgages work differently. We don't really work like traditional loans. What we do is it's based upon the age of the borrower and the value of the home. Okay.
Okay.
So 50% is a rule of thumb.
Okay.
We have to estimate everyone to live to be 100. So the closer you are to the age of 100, the more cash you're going to get.
I see.
If you're 62, you're probably going to get the least amount of money because you're anticipated to have a very long life expectancy.
Okay. So in any scenario, you have to, it's kind of as you go along, you have to sort of submit the loan to find out exactly what it is that you can get out, or is there a particular formula? How do you calculate that?
Well, basically what's going to happen, let's say you're interested in finding out what you could get in a reverse mortgage. You would call me or a loan officer and give them your date of birth, your estimated home value, and the amount of your present lien. And within a few minutes, they can probably give you a pretty good idea of what you would have access to.
I see. And we've seen an incredible increase in value in homes. The population also is increasing in age, especially my group, which is the baby boomer group. There's too many of us. It's like rats. We can't get rid of them. So anyway, with the amount of equity and the age of this growing population, reverse mortgages is probably a very good way by which you can secure some of your retirement income and investments.
Yes.
When you get approached by when you get approached by somebody, how do you talk to them about their finances, especially, as you said, the older they are, the closer they are to, the day whereby they pass away. How do you bridge the financial, which is, a good thing, to the inevitability of what's coming? Because obviously a reverse mortgage simply means you never make another payment. All the mortgage payments get added to the end. So you have to talk all this through. It takes a very special talent to do that. Most people are aware of what's going on when they get a reverse mortgage. Tell us a little bit about...
hopefully everyone should be educated by their loan officer.
Right.
Many people have heard some of the misconceptions.
Yep.
And hopefully have overcome them. I find that when we're explaining it to clients, hopefully they understand it.
Mm-hmm.
And as a reinforcement, the first step is to undergo counseling, where they kind of, once again, go over the process with the borrowers. We hope that everyone is counseled correctly on, what happens when you pass.
Right. Yeah, I think it's just one of those things that you need to talk about. And it's the product that is the most important thing when you talk about it, because obviously if you're married and the reverse mortgage is in both of your names, your name, the spouse's name, what happens if? These are all questions that are very delicate but need to be answered and asked. There was a lot of misconception years ago back in the 80s and some obvious things that went on in those days that do not occur now, as you say, and have said earlier in shows that you've done in the past. This was taken over by HUD, and like the counseling that you go through and the care that's given by the loan officer is quite a bit different than it was at that time.
For sure, yeah. And we're always going to spend a big part of our career overcoming those common misconceptions.
Right.
But the more people talk about the product, the more people call and ask that they have some kind of interest in, the better off we're going to be. And hopefully someday, those misconceptions are strictly misconceptions.
Well, right. And I think a lot of the people who were around in the 80s, let's face it, as I said earlier, the baby boom generation, the average age of my particular group is 65 and above. So this isn't, this isn't a young crowd. I think a lot of the young crowd have no idea what happened in the 80s, let alone have a fear of a reverse mortgage. Listen, Nina, I'm coming up to the end of it. I wanted to ask you one more question in terms of the interest rates for the product that you have. With rising interest rates, is this going to help, or is this going to hurt, or does this affect the eligibility portion, or not at all?
No, it's going to impact it, of course, because higher interest rates is pretty much going to mean less funds available to the borrower.
I see. Yeah. Okay.
So, but hopefully people get started the process soon enough before the rates go up.
Okay, so that's a great incentive for getting going now. Listen, as I said, we're up against it. Could you let people know how to reach you so when they do, they can talk to you about you, okay?
Sure. Yes. Sorry.
No problem.
Sure. My phone number is 480-635-2410, or you can email me at nhpenny@msn.com.
Nina, thank you very much. Once again, as always, great information about Reverse. It's a terrific product. You're the best at doing it, and I appreciate you coming on the show.
Thank you so much, Jeff. Have a great day.
And you too. I'm Jeff Barton, your voice in the mortgage industry. That was Nina Penny from Malibu Funding, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, the Mortgage Voice. The Mortgage Voice with me, Jeff Barton, is available on demand and on the air. Anytime you need to find the latest mortgage information, you can find us immediately on YouTube. We upload the video version of the show every week. Just search for The Mortgage Voice, Jeff Barton, The Mortgage Voice. You can also listen to the show on demand with your mobile device via any of our podcast partners, and we got a ton of them. Apple, Google, Spreaker, IO Clips, Spotify, Stitcher, more. Plus, we're still available on traditional radio in any number of markets, including the Inland Empire of Southern California, two great stations out there, Las Vegas, Nevada, love my Las Vegas, Albuquerque and Lake Tahoe. I'm Jeff Barton, the Mortgage Voice, and thanks for tuning in. You know, Connie Hernandez joined us now. She's been on the show many times, and we always go to her, especially around, I guess, eventful times, and raising interest rates are eventful time. I was asking her off air, and I'll ask her again now. Connie, how are you?
Fine, thank you, Jeff, for having me.
Thank you, and thank you again for being gracious enough to come on. I was asking about business. How was business? I know that a lot of businesses are actually picking up, doing better than they thought they'd be doing at this time, especially with the renewed pandemic. Looks like we're going to actually come out of that quicker than we thought. But how is your business in the mortgage mortgage space, purchase versus refi, that sort of thing?
Well, to be quite honest, it seems like things have tapered off a bit on the refi. There's not such a panic to try to get those really, really low rates, because obviously we know that the rates have moved.
Right.
I don't think it's drastic enough to move for those buyers that purchased maybe a year ago, 2 years ago. And like FHA borrowers that still want to get remove their mortgage insurance, I think those are still good opportunities. Right. But for those conventional borrowers that started off with a good rate, there aren't those really low rates to refi to right now.
Yeah.
So we'll see what happens.
Right. I think with the refis, in the traditional way that we do business, not when rates are low and keep dropping like they have been for the last 3 years, but when we're in just a steady, normal market where the rates don't move all that much, but they're, let's say, 5-6%, we see people who need to take money out of their house to pay debt. We see people who need to, like you say, get rid of the mortgage insurance. And we see people do a refi because, like I said, they needed to take money out for whatever reason. I think we're going more traditionally to what that is.
Yes,
rather
absolutely. The more traditional reasons why you would refi.
Right.
Some people would want to consolidate debt. That's
right.
a big one. Do home improvements that have been maybe deferred for a few years.
Right.
I also see a lot of people that are taking out equity from their home to help their kids with the first 3 years of college.
Right. Right.
Those typical loans are. I see more of those than just the refi trying to get the bottom rate.
Right, and I think with the rates still being, it's still below 4%. You shop around hard enough, you can get a very, very good rate still. And, there's nothing wrong with 4, 5, even 6% in terms of your mortgage interest rate. It's all about the monthly payment. Can you afford it? And if you needed to do a refi to do those sort of things, get rid of MI, or take cash out for many, many different reasons, that's still available. Look, equity in your home is really rising, and that's going to drive the refi market more than just lower interest rates.
Oh, absolutely. And, we still have those borrowers now with the opportunities of the ADUs and so many different things that are looking for a way of converting their garage or
Right.
potentially even adding a whole brand new ground-up construction in their backyard, given they have the space. So I think there's still a lot of opportunity out there. And as you said, Jeff, we've been around for a little bit. And for us, a 3.5% was an amazing rate. Normal rates for us were in the 5s.
Right. That's right. I think, I still think unless you're climbing back up into, the high single digits, 6, 7, 8%, it's going to be good. And I think it'll be in these low interest rates for another couple of years. I do not see, unless, of course, some catastrophic event happens or unforeseen, but the way the world seems to be recovering, the economy seems to be recovering, if inflation gets under control, I can see these rates last this way for quite, 2 or 3 more years, easy.
I feel the same way, Jeff. I absolutely feel the same way. I don't really see the prices of homes dropping drastically in any area.
Right.
So as long as the demand is there, I mean, as you know, we do loans in multiple states. So I see a lot of people moving out of state, maybe for retirement purposes. But from what I'm being told from agents that I work with, like, for example, Texas, they can't build the homes fast enough.
Right.
And they're actually auctioning homes off.
Wow. I have never seen that. Any new homes being auctioned, highest bidder?
New homes.
Wow.
Yes.
That's wow. And you mentioned Texas. Texas is one of those great places. Malibu Funding happens to have a license down there. They have a very business-friendly state. Taxes are not that high. And houses, even, believe it or not, you can still get a house for $200,000-$300,000 in certain areas. So you can't do that in California.
No, unfortunately, if you're looking for bigger property, bigger home, and you want to stay within that affordable price range, it's definitely not going to be in California.
What do you see as a product out there that people are using? Is it all over the board, or are they going more non-QM now versus a conventional, or is really conventional, FHA, the two things that still drive your area or what you're seeing?
Well, believe it or not, I do work with a lot of self-employed people that own their own business, whether it's a restaurant or hairstylist or even a small type of manufacturing company. And these are all people that could definitely appreciate a non-QM product. So I'm actually seeing a lot more different types of programs geared towards a non-QM, and it's to service the definite need that's out there.
Yeah, I like the non-QM. It's not the straight-laced type of loan product. I mean, like you say, they have a lot of different loans, whether it's the I-10, the bank statement, the different types of bank statements, the DSCRs, all of these types of programs. Yeah, they fit a different type of borrower, and the pricing isn't even all that different than a conventional anyway. So if you need less documentation, that's good for a lot of borrowers.
Oh, absolutely, and you hit it right on the nail when you mentioned that the rates are not that different.
Right.
There was a day when we've always had these programs. It's just the rates were just pretty much unattractive at that point. And
right.
We're talking about much higher rates than they are today. So I think because now this program is something that a lot of our borrowers need, and these lenders that are offering these programs see the need, I think they're wanting to expand on that product line. They've dropped down the rates substantially on those programs in the last, what would you say, about 2 years?
Yeah, I think so. I think, a lot of them got out until they figured COVID wasn't going to ruin the whole world, and then they got back in about 6 months later.
Right.
But the offering on all of these non-QM products have really expanded, and a lot of people are doing them, not just a few.
Correct. There's a lot more lenders, brokers out there offering the program. And it is a good program, especially for those that don't want to deal with 2-year tax returns and, everything but the kitchen sink, right?
Right. Well, the credit scores are still good on these loans. It's not as if these are lacking in borrower power. No, most of these credit scores are above 720. So,
correct.
You know, I think that's awesome. We have about a minute left. What do you think about rates? What do you think about raising? What do you think about the economy overall? Give us a 30-second synopsis.
Well, I am hoping for economy to obviously improve. Mm-hmm. I see a lot more businesses that are open. It's sad to see those businesses that didn't reopen.
I agree.
I think they did a lot to help businesses, but I think that now we're probably going to see whatever businesses are stable stay, and hopefully new businesses will come in and take over where businesses failed.
Yeah, I think that is going to happen. Listen, we're up against it. Let people know how they can get in touch with you and the area in Southern California that you work and get a hold of you as quickly as possible. I know there's need.
Ken.
Yeah.
You can find us in Covina, downtown Covina, 101 North Citrus Avenue. I can be reached on my direct line, 626-422-2017, or the office line, 626-918-2419.
Connie, thank you very much for coming on once again. I always love talking to you. I could probably do it for another hour, and we'll have you back again soon. Thanks very much.
Thank you, Jeff.
Thank you very much. That's Connie Hernandez from PMA. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, and thank you for listening to the show. Mortgage Voice with me, Jeff Barton, is available on demand on the air anytime you need to find the latest mortgage information, which, if you're buying a house, is probably right now. You can find us immediately on YouTube. Yeah, go to YouTube. We upload the video version of the show every week. Just search for The Mortgage Voice. You can also listen to the show on demand with your mobile devices via any of our podcast partners, and we got a lot of them. Apple, Google, Spreaker, IO, Clips, Spotify, Stitcher, and more. Probably 10 of them. Plus, we're still available on traditional radio. 5 stations, 3 different states, and growing. So, we're in Inland Empire in California, Las Vegas, Nevada, Albuquerque, New Mexico, and up to Lake Tahoe. Tune in and listen. And by the way, if you like what you hear, say you do so. Thank you very much. And again, I'm Jeff Barton. This is The Mortgage Voice. Okay, so let's get right to some of the news to use section. Appreciate you listening to the show. We try to give you some advance warnings of things that might affect the mortgage rate, real estate market, and we bring experts onto the show, as everybody knows, all the time, to talk about things like mortgage programs, availability of properties, and the like. Today was no exception. Thankful for the guests that did come on the show. Okay, now we never got to the 10-year yield in our earlier section. 10-year yield today is at 1.954. We're almost at 2% yield on the 10-year. Now that is significant. If we are past what they call the technical level. Now, I don't understand stock market talk. I don't know who does, unless you're in that business. I think they purposely make it hard to listen to just so that you feel like an idiot and you have to call one of these people to help you. Anyway, the 10-year note is at 1.95. That's the yield, the amount of money they have to pay you in order to buy U.S. debt. That's up huge over a year and a half ago. When COVID started, I think it was down to like almost 0.2, 0.25. We've really risen, and we will continue to risen. That's the benchmark number that you look at when you're thinking about 30-year fixed-rate loans, because that is going to help determine or push the mortgage interest rate higher and higher as we wean ourselves off of the free money that's been out there. We get back to more of a normal look at what's happening in the economy. This quote that I quoted last week or a couple weeks ago, I got to read it again, okay? This is from Reuters. Today's central bankers have the unenviable task of weaning a pandemic-hit global economy off cheap money amid unprecedented sovereign debt. Now that's true, not only here in the U.S., but you think of worldwide debt as being some massive $1 trillion number. Asset prices inflated by years of stimulus and near zero interest rates. Yeah, there's a whole theory behind the fact that if you have a calm period where you have your housing keep going up and up and up, and interest rates for the most part remain steady, you are likening it to a recessionary period, and it's only a matter of time. I don't know if that's true, but that is a theory that's out there. We'll have to wait and see. Housing appreciation, 0.84, almost 1% from November to December last year. That's an incredible number. I mean, almost as much as could possibly go up, it did go up. And that is not a good thing, most ever recorded month over month. Housing affordability, good time to buy? Yeah, only 24% say so. Yeah, down 4 points from last month. Housing availability, less than last month, that's for darn sure. And household debt up $333 billion in the fourth quarter of 2021. People want to spend money, but there's nothing to buy, and it's getting more expensive in the housing market. Now, we've heard of inflation and how inflation affects people, how it affects mostly poor people, people in the middle class and the upper class. Yes, it affects. Nobody wants to pay $5 a gallon of gas. That's for darn sure. Nobody wants to pay, $5 for a cheap white loaf of bread or whatever else has gone up in the marketplace. Orange juice, milk, diapers, you name it, it's gone up. However, the things that are really costly, like the biggest expense that you're ever going to do is your house. Buying a house today is so much more expensive in terms of what the house costs rather than what your borrowing costs are, that it's almost unthinkable. I live in a small town, about 13,000 people. When I first got to my small town, now this is going back 95, okay, so 05, 15, 20, let's say it's almost 30 years. It's not quite, it's 27 years, 28 years. But when I first got to my hometown, you could buy a ranch-style house, which, by the way, is fast disappearing in California because everybody's trying to renovate them and make them monstrosities. Anyway, regardless. So $250,000, you could buy a ranch-style house in my town. You can't get that same house. It's gone up. It's $2.5 million today. Now that is inflation, okay? That is incredible. Now, we've had 7%, and yes, it affects a lot of people, and I'm not making it light of the fact that there are many people out there hurting. I'm not sure that government policies, the way they are currently constructed, are good for you or for home prices. But I think rising costs, rising rates, and the ending of the stimulus is the way that the government's trying to say, hey, why don't all you people sitting on the sidelines, not working yet, get back to work? There was a senator, I forget what state he was in, state senator, came out and said, hey, I don't think people should ask for raises anymore because it's inflationary. Can you imagine that? This guy? Well, he's probably sitting on a pile of cash. Look, if you're working, even $15 an hour is only $30,000 a year. You can't buy a house on $30,000 a year. You could barely rent like a property. I think your average rental for a 2-bedroom is about $1,000 to $1,500 in this market. What is it in your market out there? Maybe you're down in Albuquerque. What does it cost you to rent a 2-bedroom house, a 3-bedroom house, 2-bath? I bet it's higher than $1,400-1,500. So how are you supposed to, if you can't continue to push wages? I don't know. It's another inflationary element. And I've written down here somewhere that there is this: do we grow the economy? Do we end inflation? Do we push wages so people can make a living? This is the conundrum that the Fed and policymakers at the Treasury have to deal with. Now, most of these eggheads, and I call them that because when you listen to them, you can't understand a thing. You want something to put you to sleep? Go read the Fed policy meeting, the policy paper they have on the last meeting they had when they talked about raising rates. Oh, my, that's a snore. But what is contained in there is the key to what this puzzle is. What are they going to do? Well, in certain parts of the world, they haven't figured it out either. I'll just give you a quick idea. China, loosening standards for loans, for lending. Poland just raised the interest rate 50 basis points. The Bank of England raised it 50 basis points. Lagarde, who is the, I don't know, what do they call it? The president of the European Bank, European Central Bank, she said they're going to be dovish and not really raise this year at all. So Brazil, 13% interest rate hike. Think about that for a second. You're down there and you're looking at a 4.5%. All of a sudden you got a 16% mortgage. Yikes! But this is what I'm talking about. People around the world, this is not a centralized effort. I think the pandemic printing money was a centralized effort. Put the world back in, I don't know, how to forget the number. I want to say 700 trillion, but that can't be right. Anyway, it's a big number. So I don't know what they're supposed to do. But how can you take advantage of it? I think the best thing to do is to look and find for something you like. If you can afford a payment, make it. Real estate, up or down, is one day going to be worth more than it is today. And I think longevity-wise, it's the best hedge against inflation is owning a piece of property. I know that's not the greatest advice, but that is the advice. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Really appreciate you listening, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.